In this video, we're going to focus on the features, underlying features of digital assets. So we won't be talking so much about the technology behind them, but features from an investor's perspective. The focus will be mainly on cryptocurrencies, and we will actually discuss crypto, naming some actual currencies as well. So let's focus on the differences that we observe when looking at digital assets, especially cryptocurrencies, and try to compare them to traditional assets. So I'm going to have a column for digital assets, compare them to, not crypto, sorry, compare them to traditional financial assets. So think the most classic stuff like shares, stocks, bonds, that kind of thing. And the first dimension across which we want to make this comparison is inherent value, so kind of intrinsic value in the asset. When you are asked to put a value on something like shares or bonds, well, you typically are expected to apply some kind of cash flow discounting model. So your focus will be on future cash flow that the asset, or cash flows that asset you think will generate or is expected to generate, be it a share in the form of dividends, be it a bond in the form of coupon payments and face value. A real estate, a piece of real estate also has the potential to generate cash flow from leases, right? And that's how we essentially compute the inherent value and check whether the asset may be undervalued, overvalued when we compare that inherent intrinsic value to market price. With digital assets, the problem is that they typically have no inherent value. I mean, that may be different for a digital work of art, but on its own, a digital asset like crypto doesn't have any inherent value. It doesn't generate any sort of potential cash flows, no potential cash flows. Cash flows can be expected from it. So the reason why you pay a certain price for it is because you anticipate price appreciation. You think the price will go up, that's why you buy it today, but there is nothing fundamentally sort of valuable about holding a piece of or a unit of digital currency, for example. And there is also, let's say, something called scarcity value, which is due to the fact that many cryptocurrencies have an inbuilt limit as to their supply. So limited supply, there will not be more than so and so many Bitcoin ever created. That's scarcity value. Okay, so this is sort of the first dimension. The second one is validating transactions. How do we validate that the transactions that happen in these assets? Well, for traditional assets like stocks and bonds, the way you validate this stuff is there is typically a centralized record or a centralized ledger kept in a private institution. So there is a private centralized ledger record database of who owns what at any given point in time, and this is the function performed by the CSD, the Central Securities Depository in a given sort of country. With digital assets, and this is what we discussed quite heavily in the previous video, all the ownership records and all the transaction records, ownership and transactions are recorded, in a decentralized distributed ledger. Distributed ledger, which by its virtue is not centralized, it's decentralized. And of course, we discussed various networks, be they permissioned or permissionless we discussed various ways of achieving consensus. So those protocols, those standards like proof of work and proof of stake. And depending on which specific solution is used in a given case, that will typically impact the perceived value of the digital asset, for example, a specific cryptocurrency. Now, what about using these assets as a medium of exchange? So use as a medium of exchange, i.e. being able to pay for something using these assets. Now, with traditional assets, I mean, if you hold shares or bonds, you will not use them as a medium of exchange. So classic traditional financial assets are not used as a medium of exchange. You will not pay, at the shop using bonds. But most of them are quite liquid. I mean, they are priced and valued in recognizable official currency. These are so-called fiat currencies, like the US dollar, the euro, and because they're quite liquid, they are easily exchanged into fiat currencies. Fiat meaning currencies that don't have any, let's say, backing in commodities like gold. So they are created by a central bank. And that's what you use to pay for stuff, right? That's your medium of exchange. Now, with digital assets, especially crypto, the aim of the creators is that they want to use them, or they want them to be used as a substitute for, let's say, the real world currencies, for fiat currencies, like the dollar, like the euro, and plenty of other currencies that are issued by central banks or created by central banks all around the world. So the aim is to make them, or have them accepted, as an official, a recognized medium of exchange, a way of paying for stuff. Obviously, that is not yet, the case. So currently there is still limited acceptance, although there are jurisdictions where it has become, let's say, possible to use Bitcoin to pay for stuff. There are also jurisdictions where you are actually banned from using or even holding cryptocurrencies. The reason, one of the reasons why there is still, let's say, limited acceptance, not acceptance, is limited acceptance, is especially with something like Bitcoin that is very much decentralized, it's permissionless, it uses proof of work as the protocol. There is a pretty high cost of validating and adding transactions onto the blockchain, because of the work that needs to be done by all the nodes in the network. So it's still, let's say, being held back by the transaction costs, which is simply too high for this to become a medium of exchange for high volumes. That's one of the reasons, and there are legal reasons as well, right? As we mentioned, it may not even be possible in a given country to pay using Bitcoin, or it may be illegal, in fact. So the final dimension here is legal and regulatory protection. If you hold stocks or bonds issued by a registered issuer, then you've got very well established rights as a shareholder or as a bondholder. There are certain proven standards that were developed over decades and centuries. Proven standards, well established, at least in most developed markets. Rules quite comparable across borders, obviously with some differences, but there is a lot of comparability there. However, with digital assets, right, you still have a very much evolving regulatory framework. A framework that is subject to change. This stuff is still generally unregulated, despite regulators having a closer look. It's still unregulated. There are no comprehensive rules, and as I said, it may be even banned in some countries to hold digital assets, especially digital currencies. Now, so those are the features when we compare traditional financial assets versus digital assets. And we now will focus on investable digital assets. And, in the previous video, we talked about tokens versus cryptocurrency. And we kind of said a few things about both one and the other. And I now want to focus more specifically, because this is what your book does at this point, on crypto, so cryptocurrencies, and provide us further sort of drill down into how your book how your book segments this space in the market. First of all, the crypto market is pretty much dominated by two things, namely Bitcoin and another cryptocurrency called Ether. And they account, according to the numbers in your book, which are a little bit old, for 80% of the cryptocurrency market, although that changes all the time. And Bitcoin is sort of the big one in the cryptocurrency market. So the way your book views it is there is Bitcoin, and there are, of course, these CBDCs, which you will remember from the previous video. These are central bank digital currencies, i.e. digital versions of normal fiat currencies like the, possibly the dollar, the Chinese renminbi, and so on. However, putting this aside, focusing on the ones that are not, let's say, under the influence and control of central banks, everything other than Bitcoin is described as altcoins, so alternatives to essentially the big one, that's Bitcoin. So they are alternatives to the big one, that's Bitcoin. And within this alternatives to Bitcoin, so the altcoins, okay, let's kind of drill further down, because they talk about, or the book talks about, three things. One of them, or the first one, is Ether. Now, Ether plus other cryptocurrencies is a bit confusing, or similar cryptocurrencies. Ether uses its own network. It's called Ethereum. So this is built or maintained on the Ethereum network. And what you should know about Ether, there's a lot potentially to learn, but what you should know is that Ether is an example of a programmable coin, because it's based on the blockchain. So Ether plus other programmable coins, of which an Ether is an example, can be used, because they're based on the blockchain, they can be used to construct smart contracts, which we mentioned before in the previous video, may be used to construct smart contracts. And you may remember that smart contracts are, pretty simple contracts where there is a fixed decision rule, like if something happens, then payment should be made. for example, if the price of an underlying in a derivative contract reaches a certain level, then a certain amount of money should be paid by this party to the other party. And there's no negotiation about this because all of this is preset up front, and it just happens. It gets executed. So the smart contract is a self-executing contract which gets triggered by a certain event, a certain condition being met. And you can create using Ether, but also there are other potentially similar programmable coins, these smart contracts, which is why Ether and similar ones, although Ether is the big one out of the altcoins, are often known or sometimes can be referred to as smart coins. Okay. Now, what about the other ones here? Well, let's just quickly get one thing out of the way. Meme coins. These are cryptocurrencies that are created or inspired by a joke. However silly that sounds, inspired by a joke. So they are created for entertainment value. For entertainment value. Now, the most famous of these is something called Dogecoin. Now, Dogecoin was created on the back of, somebody having a bit of fun, basically. And it was created on the back of a meme that you can find on the internet with a dog, right? This is a specific dog breed, the Shiba Inu, originally hailing from from Japan. You may find plenty of memes with this specific dog looking at you in a very specific way. Now, this dog has already passed away, by the way, but the dog spelled in a sort of in a very specific way inspired the creation of Dogecoin, which has the dog face, let's say the dog head on its picture. Obviously, it's digital currency, but it still has a logo. And even though it was set up for a joke, it actually reached extreme popularity, and its value soared due to its sort of fun potential, popularity, and also endorsement by celebrities or well-known people. A big proponent of Dogecoin was Elon Musk, and for a time he was accepting payments for Tesla vehicles using Dogecoin, which was quite fun. Now, let's put that aside, meme coins. But the one I want to focus on, or the one you want to know a little bit more about, is stable coins. Because this sounds pretty good, and it should be, although it doesn't always work out. So stable coins are designed to maintain stable value, which is obviously trying to solve the big problem of most cryptocurrencies, their huge volatility. But in order to maintain the stable value, the idea is that they get linked to some other asset, to another asset. Now, there are different ways in which you can do this. I mean, a lot of them will be collateralized or securitized by actual asset holdings. So in order to make the stable coin stable, you will actually have what's known as a reserve basket of real holdings of actual real fiat currency like dollars, or maybe actual holdings of metals, precious metals like gold, or maybe holdings of another cryptocurrency like Bitcoin. A good example of this is something called Tether. Tether, sort of was created to be backed by a reserve basket, and that's supposed to, that reserves basket should provide protection against two things: protection against or from volatility, especially when it's backed by something relatively stable like the US dollar or gold holdings. However, those are not necessarily that stable at all. And also, in case of failure, if the whole sort of thing crashes, at least there is that reserve basket which ensures there is there's some value there in the background. Now, another way to stabilize these so-called stable coins is try to do it in an algorithmic way or a smart way. So it may be collateralized by asset holdings, i.e. the reserve basket, but also you may try to achieve this stabilization in a smart or algorithmic way, which gives rise to smart or let me just look at this again. Algorithmic, apologies for that, stable coins. And these will typically not hold a reserve basket. Instead, but there are so many variations on this, right? But instead you'll have an algorithm that automatically controls supply. So if, for example, the value of the stable coin, which is supposed to be stable, swings about too much, for example, goes up too much, you'll try to control that swing and placate it, make it lower by creating more of the coin. If it goes down, you'll try to kind of redeem it in the market and I guess cancel it in some way. So there is an automatic stabilizer that tries to prevent this from happening. A good example of this would have been something called Terra. Now this is already a defunct currency because it was pegged to I think to the dollar. There was Terra USD, and that peg, well, they weren't able to maintain the peg, to be honest, and the whole thing is now defunct. It doesn't work. It proved not to work ultimately. A special case of stable coin, let's say, which you may want to sort of register somewhere in your mind, a special case of stable coin is something called the asset-backed token or an asset-backed token. Here, the idea is that the asset-backed token should maintains parity with a chosen asset. All of this looks very similar to what you do when you, for example, peg currencies against another currency, right? Like the US dollar. So a chosen asset like the US dollar or gold typically, but this is done via the process of tokenization. I don't need to know more about that. For now, just know that asset-backed tokens are considered to be a specific form of stable coins. And this is pretty much what you need to know about cryptocurrencies, their different forms. Obviously, let's not lose track of the fact that the original big one is still Bitcoin, followed by Ether, and everything else also is added here more as a way to test you on things or provide you knowledge which may be tested.